This is Horizon's Middle East and Africa. Our top stories this morning. Risk off, U.S. futures fall and the dollar weakens as President Trump says he will set unilateral tariff rates within 2 weeks. The latest threat coming just a day after Chinese and U.S. officials talk down their own trade tensions. Treasury yields also slumping after strong auction demand for 10-year notes. Benign U.S. inflation data boosting the outlook for more than one Fed cut this year. And the U.S. orders some staff to leave the Middle East after Iran warns of retaliation in the region if nuclear talks collapse and it comes under attack. It's just gone past 8 a.m. across the Emirates, 6 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. Happy Thursday to you, and it is quite a busy day as well. Again, comments from President Trump overnight, stoking a bit of risk-off sentiment as we're seeing in the markets. Let's just take a look at where markets are positioned ahead of the trading day. As we were mentioning there, U.S. equity futures ticking lower right now. S&P futures down just over 0.3%, coming after President Trump made those comments about unilateral tariffs, again dialing up some uncertainty for the markets right now. The move also comes after what was a losing day for Wall Street, at least for the S&P index, snapping a 3-day winning streak. The Bloomberg dollar also, meanwhile, weaker this morning on many of those comments against most of the dollar's G10 peers, with the yen one of the biggest gainers there. A weaker dollar, also Trump's overnight comments contributing to a boost in safe haven demand, as well as what we were mentioning there at the top, potential escalating tensions in the Middle East. We're seeing gold up for a second day. Gold right now up just over 0.5% there. And also the U.S. 10-year yield, we were mentioning that we did see U.S. Treasuries actually extending gains on Wednesday following that softer than expected inflation report, and also a strong demand for 10-year notes on Wednesday. Yields right now down for a fourth consecutive day, with the 10-year at just 4.40%. But investors, and I want to bring this chart to your attention, investors not necessarily giving the all clear for the next highly anticipated bond auction, and that's coming today. That's today's $22 billion 30-year bond sale. There's a lot of focus that's being paid attention to this. We've seen yields on longer dated debt actually soaring in recent weeks, that coming off the concern over ballooning government debts in the U.S. and elsewhere. So focus will be on whether we'll see increased demand like we did see for the 10-year notes on Wednesday. But let's get back to our top story. President Trump says he's planning to send letters to trading partners within the next 2 weeks to set unilateral tariff rates. That's ahead of a July 9th deadline to reimpose higher duties on dozens of economies.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries telling them what the deal is, like I did with EU.
But when it comes to the biggest negotiation, Trump says Washington's framework trade agreement with Beijing is, quote, a done deal. That will include upfront shipments of rare earth materials. Now, the relative calm in the markets, though, didn't last as long as Trump's latest tariff comments reignite uncertainty. Stocks are down along with the dollar. For more, let's bring in Avril Hong, who is standing by in our Singapore studio. Avril, we're seeing a risk-off sentiment really take hold. Dig into that a bit for us.
Yeah, Asia stocks are edging lower. I mean, following on from Trump's tariffs comments, what it's really done is meaning this reemergence of trade uncertainties for investors about a week after that Trump phone call and a couple of days after U.S. and Chinese officials voiced optimism about this tariff truce. So it's mostly risk-off in the region, though you have an outlier. I'll get to that in just a bit. The declines today are being led by the Japanese stocks, and not helping is some of that profit-taking against the backdrop of a rise in oil prices. Remember, Japan is a net importer of the commodity. Also not helping is the surge in the Japanese yen to the highest level in about a week, and it is among the top gainers in G10s versus the greenback today. Now, as to why South Korea stocks are outperforming today, investors seem to be continuing to bet on equities in the country following on from the presidential election last week, and that seemed to help remove a lot of the political uncertainty in the country that we've been seeing for months. But as I say, it's mostly risk-off in the region, no thanks to Trump's tariff comments.
Thanks so much, Avril Hong in Singapore. We'll check back in with you in a bit. For more on the latest tariff comments, let's bring in our senior editor, Bill Ferries, who's joining us now. Bill, so it seems like Trump is sparking urgency among trading partners yet again, but is this all a play in Trump's playbook?
Yeah, it very well could be. I mean, there was a lot more questions than answers when Donald Trump announced that trade deal or that agreement with China in London, and then started commenting over the following hours about trade deals in general. We don't know. In the middle of May, he also said that letters would be going out to trading partners within a couple weeks, potentially just setting tariffs rates. He does seem to have this inclination to offer a take it or leave it deal out there. That may suggest that the talks aren't moving as quickly as he had hoped. But July 9th in the White House's world is still several weeks away. There's still time to either make deals or offer extensions. And I think it's going to be a wait-and-see mode up until the last minute in terms of whether there really are deals to strike or whether this process kind of unfolds over another 30, 60, or 90 days.
And Bill, we also did hear at the same time from Commerce Secretary Howard Lutnick, who has been in negotiations, talking specifically about the EU and UK trade deals and a bit of his frustration there. What's the progress on that front?
Well, yeah, Commerce Secretary Howard Lutnick basically saying that he thinks the EU will be among the last blocs to reach any kind of a trade deal with the U.S. We've heard repeated expressions of frustration from the administration. We had Treasury Secretary Scott Bessent saying that he thinks the EU has a, quote, collective action problem because you're not just dealing with one country, you're dealing with more than 24 at a time. So making quick agreements can be a little bit harder. There's also just a philosophical and political difference in how the Trump administration views a bloc like the EU. So I think that is adding to some of the tensions there. But essentially, the U.S. Signaling that talks have not been going well and that they don't expect the EU to be anywhere near the front of the line when deals start getting announced.
Thanks so much, Bill Ferries, starting us off there. Bill, great to have you on. Now, the U.S. core inflation rate rose less than forecast in May, suggesting companies are absorbing higher tariff costs instead of passing them on to consumers. President Trump seized on the soft CPI reading, repeating his call for the Fed to slash rates by a full point. For more, let's bring in FX and rate strategist. That's David Finnerty. So, David, softer than anticipated CPI, but it doesn't seem like the all clear is in for inflation moving forward or the Fed to make more cuts. What's your assessment of how the markets are interpreting this print?
Yeah, certainly said the core data, which what markets were focusing on, came in lower than expected. And as we know, markets are only too happy to price in rate cuts if they get a chance. So they really said, OK, well, we think 2 is done for this year. Obviously, we'll look forward to what the Fed says next week. But ahead of that, you actually have the PPI data out tonight. And some of those measures, PPI components, will feed into core personal consumption expenditure index, or core PCE, which is the Fed's preferred measure of inflation. So I think they'll be looking for confirmation tonight in that PPI data that the PCE will also come in weak, and then the markets will go, well, hopefully that will mean the Fed next week will act. Now, of course, based on Fed rhetoric, though, it said, look, we will act, but we're in no hurry to act. The most recent dot plot did signal 2 Fed cuts. We'll be interested to see next week, is that when a next dot plot is due, does that also signal 2? And if it is 2, you think it's more towards the end of the year, certainly rather than, say, in a September cut. So the market at the moment goes 2 is what we're looking for. If we've got a chance of 3, we'll certainly run with it. But I don't think there's enough data out there yet, particularly with uncertainty over how these tariffs will play out. And the Feds can be very well aware of that. And the Feds can say, look, we need more data, more information to really make sure that the tariff impact, if there is any, is really muted on price pressures.
How do you read, David, into what we did see was a strong demand for U.S. 10-year notes, on Wednesday, and also potentially the implications for the second auction for 30-year notes today?
Well, I think certainly the 10-year went well. It did come basically on the back heels of the CPI data, which I think helped boost it. The 30 years sort of a bit more interesting. Obviously, it's a lot longer in the tenor. It's an extra 20 years. And I think it really does go to show, it will show how much is the market's appetite for debt. I mean, you have to think at the end of the day, the budget will be passed at some point. We don't know exactly what it will entail because it's still at the Senate, and if the Senate amends it, it has to go back to the House to be approved. So there's still some more negotiations. But at the end of the day, you think, or the expectations certainly are that whatever bill is passed will add to the debt. And at some point you go, with the two twin deficits of the budget deficit and just the government deficit, you go, how much will... Well, at what point will companies go, or banks go, or investors go, enough is enough? Now, and I think the 30-year gives good appetite for, have they reached that pivot point yet? Or if it's a strong one, you go, OK, that's actually a very good sign, because we know this debt is coming, we know the bills can be passed, and if it comes in strong like the 10-year, then I think the market will react very positively to that. But I would say just because the 10-year went well doesn't necessarily mean that the 30-year will.
Yeah, we'll be paying very close attention to that. Really great analysis. Bloomberg's David Finnerty. David, thanks so much for joining us and for that insight. Now, still ahead, hear why Amundi Investment Institute is warning traders that it's too early to go into risk-on mode now. More on their market strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. U.S. futures are falling along with the dollar after President Trump said he will set unilateral tariff rates within 2 weeks. Joining us now is Monica Defend, head of Amundi Investment Institute. Monica, thanks so much for joining us. So you say it's too early to go risk on now. Clearly, we're seeing the risk off sentiment remaining quite fragile. What's your take on how Trump's current comments affect market sentiment?
Well, this idea of a tariff on-off is definitely not helping our market and is really giving a lot of uncertainty. I think it will be crucial today to look at the PPI numbers. The reason being, we really need to look how margins, corporate margins, will be affected and how eventually this will be transmitted to the final prices. And as such, we remain cautious on the risk on exposure on our portfolios.
What does that mean exactly, Monica? Where else are you looking potentially to hedge a lot of the uncertainty right now?
Well, the way we are crafting our portfolio is really taking relative positionings on the equity fronts. There are plenty of opportunities in Europe, in Asia. Then probably on the rate side, where we don't really see a directionality on the rates, in particular in the US. Definitely a steepening of the curve at this point for us. It's more evident. Actually, we pencil further cuts out of the Fed, probably starting in September. But again, the Fed will be policy and data dependent, but a steepening of the curve probably is the best opportunity in the fixed income market. And then hedges, gold is something that we flavor our portfolio with. What we did with some analysis, introducing into the asset allocation framework the geopolitical brick, is really how geopolitical outlook is polarizing the alternative scenario, and in particular, the weakest angle is inflation. So this is what we are looking for.
Does that mean an even further weakening then, Monica, of the dollar? We're seeing the dollar weaker today off of those comments from President Trump. Is that your expectation?
Yeah, actually, this is one of our major convictions. We're seeing this depreciation of the U.S. dollar, and this uncertainty is definitely helping this directionality with investors. There are still moving out of the U.S. assets, reallocating somewhere else, so whether it's Europe and somehow Asia. So we have as a target for the U.S. dollar versus the euro a 1.17 with a fair value of 1.24. So definitely the depreciation trend is there, and we will follow it.
How much, Monica, do you read into the latest comments, too, coming from the U.S. and China? You were mentioning what we have seen, at least in terms of moving out of the U.S. Dollar. But do you see potentially some opportunities in the negotiations between the two biggest economies?
Well, this story on tariff, as we were saying, is quite uncertain. But what is real is that the mutual needs that the U.S. and China have on rare earth on one side, critical minerals, and technology on the other. So this is a clear need for the two countries to find an agreement, and probably this is what will happen. And this is the reason why the posture between China and the U.S. is so inclined to find an agreement. Then we will need to see the details, because the framework has been published, but the details are still uncertain. So really, the devil is in the details.
Monica, finally, let's get your take on, we have a 30-year bond auction coming later today. You were mentioning curve steepening as your expectation. Potentially, the investor sentiment when it comes to that bond auction, will that change your outlook and potentially your positioning?
I don't think so. This is really related to the debt, and this is part of the sequencing that the U.S. administration has been announcing. So we started with tariffs, security, then we will have tax cuts and deregulation, which should be market positive on the equity side. Having said that, on the tax cuts and the bill, which in our opinion is quite progressive at this stage, will have an impact on the debt levels, but also on growth, which is the key variable. So you can pile up debt, but you really need to deploy growth to make it sustainable. And this is something that investors will be questioning because of tariffs that will have an impact, negative impact on growth. So this should allow further steepening of the curve.
Thank you so much, Monica Defend, head of Amundi Investment Institute, joining us there from Milan. Monica, thanks so much for your insights. Great to have you. Coming up, as Los Angeles is set for a second night under curfew, we'll have the latest on how far the protests have spread. That's coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Protests over immigration raids that began in Los Angeles continue to spread across the U.S. as President Trump escalates his crackdown by unleashing new federal powers. L.A. remains the epicenter of the demonstrations, with roughly 600 arrests. The downtown area is set to be under curfew for a second night as Mayor Karen Bass tries to stop vandalism and looting. For more, let's bring in Bloomberg senior editor Derek Wallbank for more. Derek, what more have we been seeing on the ground there in L.A.?
Well, Jennifer, thanks for having me. We've seen a continuation of protests about immigration policy under the Trump administration and the rapid rise in deportations and the more aggressive posture to trying to remove people from the United States who are on questionable immigration status. And, we've seen some copycat protests around the U.S., some other cities where we're seeing similar demonstrations. But Los Angeles, as you said, does remain the epicenter of these demonstrations. It has not been maybe as hot of a demonstration as you would have seen over the weekend, particularly on Sunday, but demonstrations are continuing actively. There is that curfew in place across kind of a 1 square mile section of downtown Los Angeles.
And Derek, we're still hearing the Trump administration defending the use of the National Guard, even as we're seeing protests spreading to other parts of the country. What's the significance of some of these moves here and the rhetoric around it?
Well, it's certainly an escalated response. The use of the National Guard is maybe not completely unprecedented, but not done much in recent memory. The National Guard is, for people who are abroad, it's sort of a reserve force of military troops, and the National Guard is usually controlled by the state governor. There's National Guards all across the country. So the California National Guard would usually be controlled by Gavin Newsom, the Democratic governor there, and possible 2028 presidential candidate. What Trump has done here is he's sort of federalized the National Guard, come in and said the federal government is going to take control of this and say, this is where you need to go, this is what you need to do. So that is a pretty substantial escalation. We have seen a National Guard call up in Texas under the authority of that governor. That has not been a federal response, to sort of respond to some protests there. But a state call-up versus a national call-up, that is an escalatory difference, especially when the governor does not agree with the need to call up. We have seen Los Angeles officials join state officials in saying that it's an escalatory step, that it's not one that's necessarily been needed there. So there is that continued divide, as well as legal action about whether or not that deployment was appropriate.
Right, yeah, especially between Gavin Newsom and President Trump. Bloomberg senior editor Derek Wallbank joining us there. Derek, thanks so much. Always great to have you. Now, for a look at some of the other stories we're following, the Trump administration has launched a review of the Biden-era AUKUS military pact with Australia and the UK. The Pentagon says it will study whether the deal aligns with Trump's America First agenda as it shifts the burden for collective defense to its allies. The 2021 deal involves the U.S. selling Australia up to 5 Virginia-class nuclear submarines as the allies develop a next-generation sub. And Bloomberg has learned the G7 won't try to reach consensus on a joint communique at next week's Leaders Summit in Canada. It's an acknowledgement of the wide gulf that separates the U.S. from the other members on Ukraine, climate change, and other issues. Instead, host Canadian Prime Minister Mark Carney is looking to ease tensions with the U.S. president and push forward with talks about trade and security. And let's take a quick check at where your markets are positioned. As we were mentioning, a risk-off sentiment clearly settling in right now. We're seeing S&P futures down more than 0.3%, as well as NASDAQ futures. Also looking like Eurostock 50 futures potentially a weaker day to start this Thursday there. Now, coming up, oil prices edge lower as traders monitor Middle East tensions and U.S. trade policy developments. We dig deeper into that next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Risk off. U.S. futures fall and the dollar weakens as President Trump says he will set unilateral tariff rates within 2 weeks. The latest threat coming just a day after Chinese and U.S. officials talk down their own trade tensions. Treasury yields also slumping after strong auction demand for 10-year notes. Benign U.S. inflation data boosting the outlook for more than one Fed cut this year. And the U.S. orders some staff to leave the Middle East after Iran warns of retaliation in the region if nuclear talks collapse and it comes under attack. It's just gone past 8:30 a.m. across the Emirates, 6:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg. And as we mentioned there, it is a risk-off sentiment that is setting in. And you can see that if you take a look at where futures are positioned right now. S&P futures ticking lower, as we're seeing also NASDAQ futures ticking lower after those comments we got overnight from President Trump on unilateral tariffs, again dialing up the tensions and uncertainty in the markets right now. S&P futures down just about 0.3% there. The dollar, meanwhile, also weaker this morning, just under 0.3% there, weaker against most of the dollar's G10 peers, with the yen among its biggest gainers. The Bloomberg dollar also has hit its lowest level since 2023. And the weaker dollar also trumps overnight comments, in addition to potentially escalating tensions in the Middle East, as we were just mentioning there, seeing increased demand for haven assets. Gold is up more than 0.5% there, up for a second day. And the U.S. 10-year yield right now at 4.40%, extending Wednesday's gains after we did see, as we were mentioning there, softer than expected inflation, a strong demand for the 10-year yield. But that brings my attention, or I want to bring your attention now to the next bond auction that is in focus, and that is the $22 billion 30-year bond sale coming today. Investors not necessarily giving the all clear after that strong 10-year yield sale. Yields on longer dated debt have actually soared in recent weeks on concern over ballooning government debts, in particular in the U.S. So the focus will be on whether or not we'll see a similarly strong demand as we did see on Wednesday with the 10-year. But let's check in on how markets in Asia are faring. Avril Hong is standing by in our Singapore studio with more. Avril, what are you focused on?
Yeah, we're zooming in on Chinese assets today. I mean, given Trump's comments, don't forget, he also signaled that this trade framework with the Chinese side seems to also be in place, while at the same time suggesting that Beijing will supply rare earth. So we're seeing a bit of a reversal on the Hang Seng from the gains a day ago. CSI 300 is flat. The renminbi is among the currencies that has been gaining ground against the greenback today, helped along as well by a slightly stronger fix by the PBOC. This is for the third session, and it also signals the Chinese central bank quite steadily guiding the Chinese currency stronger. I'd also just highlight that we are seeing signs of recovery in the Chinese property sector, which of course is the heart of the domestic troubles in the economy. We're seeing how there's marketing of a private company, a developer, in terms of a dollar bond offering, and this is something we haven't seen in about 2 years, and this comes against the backdrop of signs that authorities are a bit more willing as well for policy support now for the sector. So we're seeing these Chinese stocks, Chinese developer stocks in Hong Kong actually gaining ground today. Jen?
Thanks so much, Avril Hong in Singapore for us. Now, the U.S. has ordered some staff at its embassy in Baghdad to leave, while family members of U.S. military personnel in the Middle East will also be allowed to depart. Statements announcing the decisions did not cite any specific threat, but it came as President Trump cast doubt on progress in Iran nuclear talks and with Tehran saying it would retaliate to any military attack. Stuart Livingston-Wallace is Bloomberg's executive editor for MENA and Russia and joins us now. Stuart, how serious is this move by the U.S., and does it actually suggest potentially we're going to see a direct confrontation with Iran soon?
I mean, I think that is a very hard prediction to make. Certainly what we can say is that from the Israeli side, they have been deeply concerned about Iran's nuclear program for many years. They have been planning ways of taking it out militarily for many years. What seems to be a little different this time is that obviously the US and Iran are engaged in attempts to come to some sort of agreement that is a sort of a return of sorts to the nuclear agreement we saw under Obama. But both sides have set out red lines that seem entirely incompatible. So, for instance, the US says there is no way that Iran should have any enrichment capability. Iran says that's an absolute red line and it must have some because it is a signatory to the non-proliferation agreement. So I think there is a mounting sense within the region that these two sides are incompatible. At the same time, you have Israel clearly very keen to do some sort of military action to degrade at least the nuclear capabilities within Iran. So I think that's why you've seen what you've seen.
And we're also seeing, as you were mentioning there, Israel, that we saw members of parliament rejecting an opposition bill to dissolve parliament. Is this a win for Netanyahu?
Yeah, I mean, I think you can definitely say that it is. I mean, in effect, what this does is that it stymies the opposition's ability to reintroduce another similar bill for 6 months. So that's how long they have to wait before they can do it again. Now, they have said that they're not going to be terribly keen on supporting any legislation going through the Knesset, but of course, Bibi has a majority there, so he can probably continue to get legislation done. So yes, I mean, in terms of the immediate threat to him, that doesn't seem to be on the table. But again, you know, this is Israeli politics and things change rapidly, and something we'll keep an eye on in the months ahead.
Stuart Livingston Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia, joining us there in Dubai. Stuart, thanks so much. Now, oil prices are holding on to Oil prices are holding most of a big jump on Wednesday. That coming as traders monitored the Middle East tensions and U.S. trade developments. Let's dig into this more with Rachel Ziemba, founder of Ziemba Insights. Rachel, great to have you on. We were just speaking to Stuart there about some of the tensions that we're now seeing within the Middle East between the U.S. and Iran. Can you walk us through potentially how this affects where we're at right now with oil prices and the trajectory moving forward?
Thanks, Jennifer. Pleasure to be with you. I think this jump that we saw in oil prices yesterday was partly a factor of that concern about the Middle East, also partly just some general optimism on whether the Fed would be easing and other dynamics. Now, look, we're seeing news reports about Israel being ready to strike Iran. Now, they seem to be always ready. That's always part of military planning. As Stuart says, it's hard to pick a time. We also, just before we went on air, I saw that Witkoff is still scheduled to meet with the Iranians on Sunday. That hasn't been called off yet, but I don't think many people are optimistic that they are close to a deal. And we are near that self-imposed timeline that Donald Trump issued. So I think there is a reminder of the geopolitical risk present. I also think that there is some skepticism about, OPEC Plus and how much additional supplies they've added. So I think the market the shorts are exiting, and there's some question about whether in this summer greater demand season, the oil market is tightening, and that's what's going on.
Well, and Rachel, there's also the impact of potentially what the Trump administration had wanted to do, which is drill, baby, drill. We got some insights into potential stockpiles in the U.S. How does that factor potentially into a weakening of oil right now?
So, I mean, I think, this show's been kind of out in front of kind of questioning whether there would be drill, baby, drill back even at the end of last year. And I think we saw the first confirmation even from the U.S. Energy Department earlier this week that drill, baby, drill isn't happening, that the combination of demand uncertainty and tariffs, which pose price and cost uncertainty, is meaning that U.S. producers of oil, particularly shale oil, aren't drilling more anymore. Rig counts are down. It might not be a big fall, but this is a shift after several years of considerable increases. So at this point, continue to see high volumes out of the U.S., but not climbing to the same extent. And maybe that provides more space for the global oil markets to absorb these barrels from OPEC, that OPEC Plus is sort of adding onto the market. I think the market's also trying to absorb exactly how extensive the sanctions pressure will be. We saw the Europeans proposing some more extensive oil sanctions on Russia. At this point, the U.S. is not playing ball, so I'm not sure how impactful that will be. But, wait and see the G7 meeting over the weekend and early next week. So far, the Iran and Venezuela sanctions are just sending oil at a discount to China. So overall, in my view, I think the market's probably overreacting to this political news. But these are tense times, and the realization that it's not so easy to get to a nuclear deal is something that the Trump administration is having to grapple with. And any escalation could increase the risk of, pressure, sort of pressure on energy assets. So I think waiting and watching. But at the end of the day, from my mind, the fundamentals haven't changed that much.
Do the deadlines, though, Rachel, if we talk about tariffs in particular, there's July 9th. There's also President Trump saying that he's going to be sending letters unilaterally to countries. How much do those deadlines then still matter? Is it about the fundamentals, as you're alluding to there?
Yeah, so I think the deadlines do matter, partly because companies have to act as if those deadlines matter. So we saw earlier this year a lot of front loading, rushing to buy more goods ahead of tariffs coming into place. We could see that happening again. President Trump, as you say, has said two very different things in the last 24 hours. His Commerce Secretary also said that where China is concerned, the tariffs are here to stay. But we can't forget that there's a looming legal case that so far has gone in the administration's favor temporarily. Tariffs are still on, but the Court of International Trade has said that the administration went too far in imposing reciprocal tariffs, and those are some of the measures that might be in this letter. So I do expect in the next few weeks we will see some more deals announced. We will see some more frameworks or memorandum or hopes for deals, which probably mean the tariff can will be kicked down the road to some extent. If so, that would be good for financial investors, but it's not great for business who don't know from one day to the next what the cost of the goods they're importing will be.
Yeah, certainly a lot of conflicting messages out there for investors to digest. Rachel, it was great to get you on, though, to try to help make sense of that. Rachel Ziemba, founder of Ziemba Insights. Thanks so much, Rachel. Great to have you. Now, DHL Group says it plans to invest about 500 million euros in healthcare services in Africa and the Middle East over the next 5 years. That's as the company looks to capitalize on China's push into the regions. DHL's Africa and Middle East operations will focus on specialized warehousing, packaging, and supply chain management, ensuring proper tracking of drugs and medical devices from production to destination. And coming up, with record high gold prices, some of Zimbabwe's informal miners have started to cash in. A closer look at that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The 3-year surge in gold prices driven by President Trump's trade war is enriching Zimbabwe's more than 700,000 informal miners. In one rural town in the southeast, the streets are packed with BMWs and Land Rovers, and modern houses are springing up, paid for in cash. Let's get more with Bloomberg's Ray Ndlovu, who's joining us now. Ray, artisanal miners, very important talking point depending on where you look on the continent. How important are they in Zim?
Yeah, good morning, Jen. Absolutely. All that glitters is gold, literally right now in Zimbabwe and across the continent. The price of gold has been surging, and the informal miners contribute about 60% of all output in Zimbabwe. And that's pretty much almost the same ratio, give or take, everywhere else across the continent. So you're finding that their role is increasingly becoming important in the scheme of things right now when you're looking at the gold rally and nations which are, gold rich, pretty much trying to cash in on this rally and boost their revenues. For instance, if you look at a country like Ghana, they are projecting that they could be earning about 12 billion at the end of next year just from the output from small-scale miners. You've got also central banks across Africa recording, an increase in gold reserves. That's from Ethiopia to Uganda. So many of these artisanal miners are really playing a key role in economies across the continent. And this small town in Philippines that we visited as well, is a microcosm of, that boom that's taking place and mirrors what's taking place in different parts of the continent as well.
And Ray, we're looking at a chart right now for gold. Unclear of how high gold prices are actually going to go. But what are we seeing from central banks across the continent as it pertains to gold, and also as it pertains to a lot of the currency fluctuations that they've had to have? How are they reacting to this?
Yeah, I think Goldman Sachs puts end of year forecast for gold at $3,700 an ounce. So, that's a very, from where we're coming from back 2 years ago, the price is almost doubled. So I think the sentiment from central banks really is to buy gold. We've seen that trend, play out in other emerging markets as well, in China, in Poland, which are some of the biggest buyers, in India. And so African central banks have also jumped onto that trend. I think earlier this year, Kenya as well, the Kenyan Central Bank indicated that they will look at adding gold into their reserves. Namibia as well. We've got, Zimbabwe, which we've spoken about previously on the show, which has got a gold-backed currency. They've been buying gold and shoring up their reserves over the last couple of months since they launched a new currency. And I guess the biggest winner in all this equation, if you want a very good example, would be Ghana. They have almost, piled just slightly over 31 tons of gold at the moment. And, the cedi is the one of the world's best performing currencies at the moment. I think it's gained pretty much about 43% to the dollar. So we've seen that, the boost in reserves is helping currencies and strengthening them. And I think it's that central banks will continue to invest in and making sure that they're diversifying their portfolios and looking at, adding gold as much as they can because of the price forecast, which is really scorching at the moment.
Yeah, and central bankers really echoing that sentiment there. Bloomberg's Ray Ndlovu. Ray, always great reporting. Thanks so much for joining us there from Bulawayo in Zimbabwe. Now, for a look at some of the other stories we're following this morning, Ghana's economy expanded at the fastest pace since the third quarter of last year after its gold and cocoa industries exited contractions. GDP grew at an annual 5.3% in the 3 months through March, compared with 3.6% in the prior quarter. The data will be welcomed by President John Mahama, who won the December elections after pledging to reset an economy shackled by high inflation, a battered currency, and a 2022 debt default. South Africa's National Assembly has approved the Treasury's fiscal framework, bringing the adoption of the annual budget a step closer after months of wrangling over tax increases. The framework establishes economic policy, revenue projections, and limits on government spending. It was approved by 268 votes to 88 with 2 abstentions. And coming up, DoubleLine Capital's Jeffrey Gundlach tells us a reckoning is coming for U.S. debt. Our exclusive conversation is next. This is Bloomberg.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005. And there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position. And the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so this is a moment where finally you have the setup where non-US investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves away from the U.S.
Trillion.
Right, exactly, whatever it is, 3 trillion. You're getting trillions of dollars moving out of U.S. assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been
about
thinking
shorting
about
it?
this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot, because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say, this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing.
DoubleLine Capital CEO Jeffrey Gundlach speaking to us exclusively at the Bloomberg Global Credit Forum in Los Angeles. That's it for Horizons Middle East and Africa. I'm Jennifer Zabasajja in Johannesburg.